Hey guys, it's Eric. It's Friday. I'm wearing red. Please, before I forget, because I can't wait to get into this topic, subscribe to our YouTube channel by hitting that red subscribe button down to your right. Now, I get this question all the time, like almost daily, and that is, I don't know if it's a question, but basically, when I ask people, you've got way too high of an interest rate. Interest rates are in the low twos. Why are you deciding not to streamline your loan? And they tell me this, well, I plan on moving or selling in next, X years. Sometimes it's even months. And I say, so? You still have too high of an interest rate. Why aren't you refinancing? Now listen, these people are not ignorant. I'm not always right, but I want to kind of mock a little debate here real quick, and I hope you'll watch this whole video. If you've ever decided to keep a higher rate than the market suggests you should have because you have this idea that you might be moving or selling in the next year to 2 years, 3 years. What most people are doing by saying they're not going to refinance or they're going to put the whole thing on hold is very simple math. And the math on the surface is very smart. It's called a recoup test. Okay, and they're basically saying, well, it's going to cost me $5,000. That's how much my balance is going up. Let's even get a little crazier here. Say, you guys want to increase my balance $10,000, and I'm only saving, cost, and I'm only saving $100. I'm going to use simple math because it's just easier for me. A month. That's what they're saving a month. So if you divide 10,000 by 100, you get, did I do this right? That is 100 months to recoup. Simply put, if you're not going to be in your home for the next 100 months, there's no point in doing this loan. And therefore, that's why people say, well, I'm not going to refinance if I plan on moving in the next 3 years. 3 years is only 36 months. So why would I do it? And I agree. Why would you do it? Now you might say, well, then why is the video not over? Seriously, keep watching. And this doesn't work every single time. I'm not suggesting every single person who can refinance should. There are variables like moving or selling your home that you should take into consideration. But I also want to talk to you about, I don't want to say reality. I'm struggling to think of the word right now, but here's the situation. Number one, a lot of people think they have to sell the VA home that they're in now in order to buy another one, and you do not. So there's been so many people who pass on a refinance when rates are low because they're moving. Again, we're going back to this, people are moving soon. That's what we're talking about today. And then when they move, they realize, I can't sell my house because the market's changed, or I don't want to sell my house because property values keep going up and I've got renters that'll pay me way more than my mortgage payment, and they keep their house. So before you just say, no, I'm not going to do it because I plan on moving soon, consider this. What if you keep the home? Real estate investing is huge. Veterans have a major opportunity to keep the home that they're in right now and then rent it out. And if you refinance down to the low twos, which is where we are during the filming of this video, let's just say you can increase your cash flow by renting that house by an additional $100 a month. Why wouldn't you do it? Now that 36-month recoup that you were doing, they'll all come back to that recoup because that's where I'm going to end the video, isn't as important if you don't plan on moving. And you can buy another home if you have enough remaining entitlement, which many, many veterans do. We can help you determine that. So maybe keep your home. And then it does make sense to refinance. Another thing that I would suggest, this is more math. We're going to go back to this idea of the $10,000 in closing costs. People say, well, I know I'm going to sell my house, Eric. I'm not going to be renting the house. And you're saving me $100 a month. And it's going to take me, so again, cost, $100 saving, recoup is $100. Keep this in mind. The VA does not allow us to give you a loan that you cannot recoup within 36 months. That's a new VA rule from a couple of years ago. We've got many videos about it. So we're going to get your recoup down to 36 months. We're going to. We have to. There's no other way around it. You may say, yeah, but I'm moving in 2 years. 2 years is 24 months. Okay, well, this is a two-part example, and I know I'm running out of time, so we're going to go quicker here. Number one, just because you're adding $10,000 to your loan, that's not all closing costs, and that doesn't all have to be recouped. I want you to keep in mind, when you refinance, you normally defer 2 mortgage payments, which means you don't make, anyone that's closing, for example, in the month of December, they're not going to make their December payment. They're not going to make their January payment. Their first payment won't be due until February. So if you look at 2 months worth of mortgage payments, let's just say that's $2,500, okay? Your $10,000 just went down to $7,500. In addition to the 2 months worth of mortgage payments, you're going to also, part of this $10,000 is we're setting you up a new escrow account. Every single time you refinance, you have a new escrow account set up. I want to keep my math simple today, so let's say $2,500 of that is for escrow. Well, you don't have to recoup your escrow account because that's your money. That's not a cost. That's called a prepaid item. You're also, in addition to getting the 2 missed mortgage payments, you're also going to get an escrow refund back from your old mortgage company. So we just said you really have $5,000 of closing costs that you really need to recoup. Because you can take the $2,500 of missed mortgage payments and put that in the bank. Or you can put it towards your new loan balance when the payment comes due in February. You can take the $2,500 escrow refund that you got from your old lender who we pay off in the refinance. You can put that in the bank, or you can send it in with mortgage payment number 1 in February. Both situations really, if you're trying to be intelligent and determine whether or not you should do this loan, you need to recoup $5,000. You get this money back. It's already recouped. You need to recoup $5,000 by the time you plan on moving, if you are dead set on moving. Well, now we take 5,000 divided by 100, and we get what? 50 months. Now you may say, oh, I'm still going to move within 50 months. Keep in mind, I got to get you to 36. I got to get you to 36 months. So the loan officer is going to come to me as president of Low V Rates and say, hey, can we do something here to get this down to $3,600? Because my client, if he or she can recoup in 36 months, number one, we meet VA guidelines, which we have to do, and I think they'll consider it. Well, heck yeah, if we can do it, we're going to do it for you. And there are ways in which we can do it that I won't go into this video, but we have that power as the lender making the decision. So here we are now, and you think you might move in 24 months. So the question that we're going to finish up with remains, it's taking me 36 months to recoup. I'm going to sell my home in 24 months. Why would I do it? All I can tell you at that point is I'm still saving you $100 a month. So in 24 months, I just put an additional $2,400 in your pocket. Can you use $2,400? Is it really going to make that big of a difference when you go to sell your house? No, it's not. But if $2,400 can do something for you right now, there's one reason to consider it. Also, what if things change? I know we are creatures of habit and we think, no, I know I'm moving in 2 years. Well, the economy turns. You don't get the job increase, the pay increase that you thought. And now you can't go back and say, man, I should have refinanced when Mr. Loan Officer Eric was telling me to refinance. So again, I'm rambling. Here's what I want to say. Don't just discount the idea of a streamline because you and your family or just you by yourself think you might move in a couple of years. Number one, you don't have to sell the house and you can start down the path of real estate investor, which is a great way to get ahead in life by keeping your house and renting it. And the lower your mortgage rate and the lower your mortgage payment, the better your cash flow, and things change. Someone told me one time, I think I got this right, a bird in the hand is better than 2 in the bush. Does that sound right? I think I said that right, and forever I didn't understand it. Well, a bird in the hand right now is you've got historically low interest rates because of COVID and because of an election and all this other stuff. Rates are so low, take advantage. You don't know what's going to happen 2, 3, 4 years from now when you intend to move. So I hope that was helpful. I'm sure I went over 4 or 5 minutes. I didn't go too far over, hopefully. Watch next Friday for another amazing Red Friday video.